Okay, so today we're going to start the next section of work. We're going to spend 2 weeks looking at this section, and this section is also going to be in every question that you get. Every question that you get in your exam will have a piece from this section. We're dealing with IAS 8. IAS 8 deals with accounting policies. And it has a little bit of theory in the beginning, which is all about how we choose accounting policies. And as you know, the accounting policies are in the IASs or IFRSs. And sometimes we have a choice of accounting policy. Yeah. Sometimes we're told what accounting policy to use. IAS 8 goes into a little bit of a discussion, which is not something that you really need to know at third year, about what to do if the transaction that you are trying to account for isn't covered by one of the IASs or IFRSs. In South Africa, we had a particular example a few years ago when we started to see BEE transactions, Black Economic Empowerment transactions. And so there was a question then on how exactly to account for those. And at that time, there was no guidance. Yeah? So when there is no guidance, the statement then says to you, look at framework, because framework provides your skeleton essentially. The statement also says look at academics. So look at textbooks that have been written, academics. Also the statement says look at practice. What is the general practice in the industry? Because if you are dealing with a certain transaction, chances are that there are other companies in the same industry also dealing with the same transaction. Here's my shapes now, but I don't want to do that. Also dealing with the same transaction. So, yeah. So much for that. Okay, but what we're going to look at in terms of IAS 8 is actually 3 things which are actual calculations or things that affect our financial statements. We're going to look at situation 1, when there's a change in an accounting policy. What happens when there's a change in an accounting policy? Changes in accounting policy can occur for 2 reasons. Either there's a change in IFRS. So there's a new IFRS, and the new IFRS says you are allowed to do XYZ. Yeah? So when there's a change in IFRS, then we could have a change in accounting policy. The other one is when there's a change in management decision. So when management decides, and remember when I was talking about IAS and IFRS, I said to you that there are in those options of how to account for things, isn't it? Let's look at an example. You're allowed to carry PPE at cost or at reval, isn't it? So if you had chosen reval and now you decide that you rather go back to cost, it's too expensive maybe to do the revaluations every couple of years. It's too time consuming. It's not really giving you extra value. You don't feel that it's giving extra value. The revaluations that you're getting are not that different to what it would have been if you just carried it at cost, less depreciation. You might decide to change back to cost model, isn't it? So changes in accounting policy occur when there's a change in IFRS or a change in management decision in the policy they're going to apply. And the important thing here is that we have to give information to our shareholders, give information about this change and about the effect of the change. Because obviously the change has had an effect on your numbers. And you need to give that information. So that's the first one. That's the one we're going to look at today. We're also going to look at changes in estimate. And usually these estimates are the ones that you're going to come across anyway, are things like life of an asset, residual value of an asset, depreciation method. It might be things like obsolescence provision. warranty costs, could be any of those, hey. Anything that involves management somehow having made an estimate of a number. And when management has to use their judgment to make an estimate, it happens that that estimate changes because facts change, because you can look back and say, oh, I was a bit wrong with that. And so changes in estimate also require disclosure, and we're going to look at those next week. And we're also going to look at another thing which is included in this standard, what we do when there are errors. What we do when there are errors in the financial statements that then need to be corrected, and how we disclose those. So what you can see from everything that I've written here is that this IAS 8 is all about disclosure. It's all about disclosure. It's about disclosing to our shareholders when we have changed accounting policy, accounting estimates, or when we've had errors, and how we have dealt with those changes and those errors, and the effect that those have had on our numbers. Yeah, it's all about disclosure. So as I said, today we are going to do, before the example, today we are going to look at changes in accounting policy. And I suppose when we're looking at changes in accounting policy, what we need to remind ourselves of is that one of the qualitative considerations or characteristics in the framework is that our information is comparable. Yeah, comparable and consistent. So the important thing with accounting policies is that they are consistently applied period after period. And whenever we have a change in accounting policy, therefore, and this is interesting, the rule is that we must account for this change in accounting policy retrospectively. In other words, I must go back and I must fix my numbers, assuming that I had always accounted for it in that manner. So if I had been using the reval method and I decide to go back to cost, I will go back and change all my numbers to look like they would have looked if I had been using the cost model all along. Yeah, retrospective. Now, retrospective means we go back forever. Yeah, forever. Luckily for us, our financial statements don't go back forever, isn't it? So let's look how far back the financial statements go. Statement of financial position has 2 years. It has the current year and the comparative year, isn't it? IAS 8 says that we must show another year, the beginning of the comparative, if we have a change in accounting policy. If we have a change in accounting policy, the statement says you must show a 3rd year in your statement of financial position. You must have 2016, 2015, and beginning of 2015. You've got to show the 3. P&L, let's just call it P&L. P&L also only has 2 years. This year, comparative. Statement of changes in equity has 3 years. If you remember the statement of changes in equity, it's a movement, isn't it? So if I was looking at an example of what it would look like, I would start with beginning of 2015, and then I would do movement, and I would get to beginning of 2016, and I would do movement, and I would get to end of 2016. Do you agree? That's what shows in our statement of changes in equity. Statement of changes in equity is a movement statement. It shows balance at beginning, movement, balance at end. And so because we have to show 2 years of movement, we'll end up having to show balances for 3 years. We show beginning of 2015, end of 2015, beginning of 16, end of 16. So when we look at just change in accounting policy, even though the rule says changes in accounting policy have to be done retrospectively forever, actually, when we're doing the numbers, we only need to go back 3 years. Do you agree with me? Our financial statements in no way, shape, or form show anything before 3 years. So we just have to go back 3 years and work out the numbers for 3 years. Okay. So let me put a little highlight here on the 3 years, because that's how far back we're going to land up going. All right, let's look at the calculation. Because there are two things. There's a calculation and there's a note. Sometimes you can do the calculation straight in the note, but I wouldn't advise it, especially not in the beginning when you're still trying to figure it out. So the calculation for a change in accounting policy is to take old and new and to look at the change. And when we take old and new, we're going to look at SFP balance, and we're going to look at P&L amount. So if I used a very simple example, I'm going to use the example of the asset. Let's assume that if I had revalued the asset, then the asset would be sitting on my statement of financial position at 1,000. And my depreciation would have been 100. Let's say it's 10% reducing. Yeah? Well, that wouldn't be 10% reducing, but let's just assume that. But let's assume if I decide to go back to cost, that my SFP balance would have only been 500 and my depreciation would have only been 50. So then I look at the change. And when I look at the change, oh no, put it back in the wrong place. When I look at the change is, in the SFP, my asset needs to drop by 50. In the P&L, my depreciation drops by 50. And what that actually means is that profit goes up. Do you agree? I also need to do tax, because this is third year now. Everything we do tax, isn't it? So I would also need to do tax. And tax on 50 is deferred tax of 1414. Is that right? Yeah, 28. No, not. Yeah, 14. So that's the calculation. I look at old, I look at new, I look at change. Yeah, and I have to do it for 2 years. I have to do it. In fact, I have to do it for 3 years, don't I? I have to do this calc for 3 years. So in fact, I always put it on the board backwards. It probably would look better if you did it like this: 2014, 2015, 2016, old, new, like that, change. Isn't it? It would look better like that, because then you can put it all on one. Yeah? The 3 years, old, new, change. You do the balance, and then you can do depreciation underneath. Old, new, change, depreciation. Right? So that's your calc. Your note is, let me do the note in purple, just so that it's completely different. Do not make your note your calcs, or your calcs your note, isn't it? Don't get confused. But the note is pretty much that information replicated in a note. So the note is, first of all, a story. What happened? Why? Why did you have a change in accounting policy? What did you do? Is it management that decided that it's better presentation? Is it IFRS that changed? The story. You also need to talk about the fact that you accounted for it retrospectively. And the statement actually says, if you're unable to account for it retrospectively, you then go back as far as you can. So there was a time, for example, where they changed the rule of how we account for pension funds. Or even better, there was a time they changed the rule of how we account for forward cover transactions with the bank, forex transactions with the bank. And you needed to get values of similar forward exchange contracts at year end. Do you agree that it's impossible to go 3 years back and get a value of a forward exchange contract 3 years ago? It's impossible, isn't it? You can phone the bank at your end and ask them for the value, but you can't phone the bank now and ask them what would it have been 3 years ago. Yeah. So if it's not they have this funny word. It's called practicable. You'll see it there in your notes. If it's not practicable to go back, we go as far back as we can and we go forward. But then you'd have to explain it, isn't it? Then you'd have to say, I didn't do it retrospectively, because retrospective is what the statement says. I only went forward. Okay. So you do the blah, 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 the story, you do the retrospective, and then you do a note that talks about the effect of the change. And our effect of our change is going to be for the 3 years, current year, prior year, I'm going to call it prior year, the year before, yeah, the 3rd year back. And you're going to talk about an increase or a decrease in a balance and an increase or a decrease in deferred tax or SARS. That leads us with an increase or a decrease in retained earnings. So the first bit is balance sheet, isn't it? Financial position. So if this was the information for this question, I would say my balance went down by the asset didn't go down by 50, the asset went down by 500. That number's 140. The asset went down by 500. Because the asset went down, my deferred tax liability also went down, and the net effect is the net number on retained earnings. And then I also do the same thing for P&L items. Up or down P&L item, up or down tax expense, up or down profit after tax. Now, for the balance sheet, the first one there, I'm going to have numbers. So for this one, I'm going to have numbers in current year, I'm going to have numbers in prior year, I'm going to have numbers in the prior year, because I'm going to have 3 years of numbers, and I will have numbers there for those 3 and there for those 3. But at the bottom, I'm only going to have 2 years of numbers for P&L, because my P&L is not going to go back 3 years, it's only going to go back 2. And then what I am going to show is I'm going to show an extra number, let me make it in blue, which is retained earnings beginning of year adjustment, which is the adjustment for the 3rd year. Because the 3rd year of adjustment, when I do my calcs, is not going to show in my P&L, because I'm not going to show 3 years of P&L. It's going to show in retained earnings at beginning. All right, I'm going to work through an example with you, and then there's one in the assignment, a change in accounting policy, which you then are going to work through. All right, the one I'm working through is in your study guides. It's example 1. It is on page 66. So if you could open your study guides for me on page 66. Okay, it says, after the information was obtained from the books of the company, the directors decided to change the accounting policy. It is normally something that gets done like after the fact. They're finalizing the year end, and then they decide, no, you know what, we need to change the accounting policy. So, and they decided to change the accounting policy with respect to the valuation of inventory. They previously accounted for inventory using LIFO, but they changed it to FIFO in order to comply with the accounting statement that disallows the use of LIFO. You know about LIFO and FIFO, isn't it, from first year? Last in, first out, first in, first out. The accounting standard for inventories, IAS 2, does not allow you to use last in, first out. Yeah? It allows you to use weighted average. It allows you to use FIFO. It does not allow you to use LIFO. So they've had to change the accounting policy to comply with an accounting standard. Okay? They then give you the information. They said the value of inventory on the two methods was LIFO, FIFO. Okay, now, remember what I said to you. We're only going to go 3 years back. They love to give you like 5 years of information to try and force you to waste time doing 5 years of calcs. We are not going to do 5 years of calcs. This I'm going to ignore completely. Yeah, okay. So then my calculation is to look at the movement. Do you agree? So I look at the movement. So when I look at the movement, and I'm going from LIFO to FIFO, inventory here goes up by, is it 4.5? 4.5. In the next year, inventory is going up by, now I don't know if it's 4.5 or 3.5, 3.5, 4.5, 3.5 the next one. No, the next one is 4.5. The first one was 3.5, was it? Oh no, the next one's 5.5. I should have been able to see that. That was a bit dumb. 5.5, yeah? And then in 2012, it's going up 7.7. Okay, so there's my numbers going up. That's my inventory balances. Do you agree? So because of my change, my inventory balances are going up, going up, going up. What happens with tax if the one goes up? It goes the other way, isn't it? But tax is usually a liability. So tax would be a liability and it would go the other way, isn't it? But let me put the tax numbers on there. I'll just put them up at the top. Tax numbers, 4.5 times, I'm going to assume it's 28. Is 1260. Tax on 5.5 is 1540. And tax on 7700 is 2156. Okay, so now I've done my financial position, yeah? Because of my change in my financial position, inventory will go up, tax would come down, but inventory is an asset, tax is a liability. So when inventory goes up, it means that, think about what happens when inventory goes up. Money, value, profit, costs are coming out of my P&L and going onto my balance sheet. Can you see it happening, isn't it? Inventory is going up. Costs, which I incurred, I'm going to take out of my P&L and put them into my balance sheet, into my financial position. What happens when my P&L costs come down? My profit goes up, isn't it? What happens when profit goes up? I have to pay more tax. So that means that my liability for tax is also going up. And the reason they're both going up is because this one's an asset and that one's a liability. This is a debit and that's a credit. Agreed? It is very important that you get your directions right, because in the exam, if you had to work out the numbers correctly, but if you see there's a decrease in tax liability, you wouldn't get the marks, because you only get the marks if the number's right and your direction is right. So if you get the numbers all right, but your directions are wrong, you won't get the marks. Okay, so that's the first bit. Now I have to worry about, what if there's some space? Yeah, there's a bit of space underneath here. Now I have to worry about P&L impact. Now, inventory is a bit of a, I was going to say a bitch. Inventory is a bit of a pain when it comes to P&L impact, because what is P&L impact on inventory? It's opening minus closing. Do you agree? It's opening minus closing. So if we look at this inventory here, look, we're going this way. Hey, that's the years. From here to here, what happened to inventory? It went up, isn't it? So when inventory goes up, what happens to cost of sales? Comes down. Yeah, because they're both assets. Do you agree? Cost of sales is a debit Inventory is a debit. So if inventory is getting a debit, then cost of sales must get a credit, isn't it? So I have a decrease in cost of sales of 1,000. Let me prove it to you. I like to prove it. And for a long time, I used to always just do the proof method. Old. Opening inventory. Old was LIFO, hey. 62,500. Closing inventory, which would be a minus, hey. Opening minus closing. There would be purchases in the middle there. Closing, 32. Cost of sales is going by 30.5. Do you agree? New, FIFO, opening 67, closing 37.5. The difference is it 29.5? Somebody work it out. 29.5. And cost of sales is also going up by that. Okay, so now look. When we had LIFO, our old accounting policy, the impact on cost of sales was an increase of cost of sales of 30.5. When I have FIFO, the impact on cost of sales is an increase of 29.5. So the change in policy is making cost of sales drop by 1. Do you agree? It's dropping by 1. All right, so we will not necessarily look at that direction. We will look at the movement and look at what's happening with the movement. Yeah? So if the movement is this way, an increase, it means that I'm putting more costs into my financial position, which means cost of sales is coming down, because cost of sales is reduced when I put costs onto my financial position. So that's a drop in cost of sales, and the same with this one, because it's going exactly the same way. It's also a drop in cost of sales of 2. And for a long time I used to always just do it like that, because then like that you don't make a mistake if it's going up or coming down, isn't it? Okay. And then we have tax. So if cost of sales is coming down, what's happening with tax expense? Must be going up, because they're both debits, isn't it? They're both expenses. The one expense is coming down, tax is the opposite, and they're both debits. So that's 280. And this one as well, cost of sales is coming down, profit's going up. So 22. 616. Okay. Anybody confused about the calculations? The calculations are old, new. Start with balance sheet, move on to P&L. Usually it's more straightforward, like I showed you with our previous little quick example with the asset. With inventory, it's a little bit more tricky, because how does inventory affect your P&L? It's the movement in inventory that affects your P&L, isn't it? Not the balance, the movement. And so there's the numbers. All right, so let me show you. No. Let me show you the disclosure. All right, so this is the statement of P&L. And what you'll see is that they've adjusted the cost of sales numbers. And they adjusted the cost of sales numbers by 1,000 in the one year and by 2,200 in the other year. Yeah? Because we will restate our financials. That's what we have to do, isn't it? We have to adjust our financials retrospectively. We also have adjusted tax. And they didn't show the adjustment for tax. They should have just shown an adjustment for tax. Okay, but let's leave it at that. Okay, then here's the statement of changes in equity for the year. Here's the change in accounting policy, which is the third year. The third year. So if I go back to the third year, sorry, let's just go back to the example. If I go back to the third year, which is this year, you'll see that the net number here is 3240. Do you agree? I'm not going to show a P&L for that. I'm only going to show a P&L for that movement, which is the 2011 P&L, and that movement, which is the 2012 P&L, isn't it? The third year goes straight into retained earnings. Remember, I said to you. So this is what the statement of changes in equity looks like in that year. I start with the balance previously reported, and then I make the adjustment for the accounting policy, which is the third year back. I call it the prior year. And our number was 4500 minus 1260 from my calc. And there it is. Yeah. Okay. Then, and this is normally what they ask, is the note. Let's see if the note's here. No, next one. No, that's profit before tax, so that's not so important. Come on, behave. Okay, here it is. Here's the note. Look how long the note is. It's like almost a page. You've written it out in your handwriting, isn't it? So whenever they ask you for this note, just leave a page. I always just say leave a page and make it spaced nicely so that the examiner can read it. So this is the change in accounting policy note. You have to learn the format. But it starts with a story, and the story comes from the question. During the year, the company changed in its accounting policy on the valuation of inventory. They previously used LIFO. They changed to FIFO in order to comply with the accounting statement that disallows for LIFO. The change has been accounted for retrospectively, and comparative amounts have been restated. If it was not possible to go back, at this stage we would say we were not able, it was not practicable to go back retrospective. We were only able to go back 1 year, or we were only able to go forward from the current year. Then we have the effect of the change. Okay, they put the P&L first. It doesn't matter which one you put first. They put the P&L first, decrease in cost of sales, and these are vital that you get these words right. If you get the words wrong, you don't get the marks for the numbers. But we had worked out a decrease in cost of sales, yes, 2, 2, and 1. A decrease in cost of sales means profit goes up, means tax goes up. An increase in tax expense, 616 and 280, which is an increase in profit, 1584 and 720. Then, and what you'll see, this is important too. When I put it into my note, the financial statements always have the current year first and then the comparatives. Don't do it the other way around. It's always current year first, then prior year, and in this case, prior year, which is the opening balance of the prior year. Often when we do calculations, we do them the other way around, isn't it? We work forward. But when you present it, we work backwards. We present backwards. We present current year first, and then the comparatives next to it. All right, so there's our numbers. On the financial position, increase in inventory was these numbers that we had. 4.5, 5.5, 7, yeah. And there's the tax amounts, 2156, 1540, 1260. I'm going to talk to you about why some of them are current tax due and some of them are deferred tax due. But I will talk to you about why that is and what it means. But the numbers are the same that we worked out. Do you agree? And they are the 3 years. And then right at the bottom, you'll see the adjustment to retained earnings at beginning. Yeah, adjustment to retained earnings at beginning. And here it is. It'll balance back to that. Adjustment of retained earnings at beginning. What you'll see is that the numbers all balance. Because look at the numbers. I start with this, which is my adjustment in year 3 back. Then I put that into P&L and I landed there. Can you see it balances? And then I put that into P&L and I landed here. The numbers have to balance because that's all we're doing is we're showing a movement, isn't it? Okay. So that's your note. You have to learn it. You have to be able to do it. If you can, then put the numbers straight into the note. But I don't want you to get confused with directions and things like that, isn't it? So while you're actually doing the calc, it's helping you just to confirm, and then you can quickly plug it in. You'll see they also do a calc. Where's their calc? Here's their calc. So they do a calc 2010, 11, 12. They actually put columns in between for the movements. FIFO old, LIFO new, increase in profit, tax, increase in closing inventory, tax. So they do a big calc as well. But this is a calc. Yours doesn't have to look like this as long as yours looks like something. And in fact, if you want to just chance it and put the numbers straight into the note, you can also do that, isn't it? Just make sure that you're very careful with your directions and all of that. Okay, there's tax. I want to talk to you about tax. So I'm going to talk to you here. Okay. Tax. When a company has a change in policy, accounting policy, there are three things that can happen from a tax perspective. Do you agree with me that I'm restating financial statements going back 2 or 3 years? Yeah, or forever? Okay. So I'm restating my financial statements. I'm restating my profit. Yeah. And there are three things that can happen. Number one, SARS accepts the change and SARS reopens the assessments for prior years. If this is the case, do you agree that then I have a position where accounting equals tax and therefore it is current tax? Do you agree? I've changed my accounting, going back 3 years at least. SARS has said, okay, they will go back and reopen those old assessments and they will allow you to make the changes. So what they've allowed, what we've done is the same. Do you agree? And so SARS accepts the change. He reopens the assessments. Accounting is equal to tax. It's current tax. The second scenario is that SARS accepts but doesn't reopen. If SARS doesn't reopen, then we actually have a scenario where prior years and current year are different, because in prior years, accounting is not equal to tax, but in current year, accounting is equal to tax. Do you agree with me there? So I've already submitted returns for what were the numbers here? 10 and 11, eh? I've already submitted returns for 2010 and 11. I've now gone and changed the numbers for 2010 and 11. But SARS says, no, I'm not reopening those. Okay? SARS says he'll accept the change, but only from the current year. So what happens is that I have deferred tax in the prior years and current tax in the current year. The reason it's deferred tax is because whatever number SARS has for inventory, he'll use to work out his cost of sales. But it bounces, isn't it? A minus in the one year becomes a plus in the other, and then a minus becomes a plus in the other. And eventually we'll be at a position where our P&L and the SARS P&L is exactly the same, isn't it? But in the current year, it still won't be quite exactly the same. Because, so in the prior years, we'll have FIFO, SARS will have LIFO, isn't it? In the current year, and we still need to be a bit careful with that, in the current year, if I look at accounting, I'm going to have FIFO opening stock, and I'm going to have FIFO closing stock. Do you agree with that? Yeah. What is SARS going to have? SARS is going to have, or tax, he's going to have LIFO opening stock because he hasn't adjusted the prior years. So he's going to bring forward a LIFO number. And he's going to have a FIFO closing stock. Next year, we'll have FIFO, and he will also have FIFO. For this year, the opening stock will still be a difference. It'll be the deferred tax that's flowing through. Okay. The third scenario
let me put it up here, is where SARS doesn't accept. And when SARS doesn't accept the change, then forever amen, we will have FIFO, 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 and SARS will have LIFO, 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 LIFO. Yeah? And so we will always have deferred tax. And the reason that we will always have deferred tax is because it does roll. Yeah? What we have in inventory this year, which adjusts cost of sales, next year comes back into cost of sales. So it will always roll. That's why it's called deferred tax. It's not permanent, the difference. It's not going to always be a difference. It will eventually land up in cost of sales. It's just a question of when it lands up in cost of sales and how much versus when we put it in and how much it is. Do you agree? Okay, so you always have to read the question very carefully to see which one it is because it affects your note. And if they just ask you for the note, that's the main thing that it affects. Let's have a look at this question. Sure, lots of stories there. In this question, and I purposely ignored the section that talked about tax, paragraph 3 talks about tax. It says, assume that all amounts of material and the tax rate has remained unchanged at 28%. And then in bold, they say, SARS will not reopen the previous year's assessments, but the new policy will be accepted for tax purposes. So what does it mean in my note? In my note, it means that for the 2 prior years, this year and this year, it is deferred tax. For the current year, it is current tax. If you don't make this distinction, you also won't get the marks. Okay, so you have to get your direction right, and then for tax, you have to make the distinction. Is it current tax or is it deferred tax? And in one of those cases, it's a mix. Where the 2 prior years, it's deferred, but then for the current year, it is current tax. Yeah. I also just want to show you the tax calc. Let me see if they have the tax calc. Okay. They have a deferred tax calc. For the prior years, inventory sits in my deferred tax calc. 2, isn't it? For the prior years. So this is a deferred tax calc for the prior year for 2010. And you'll see inventories here because this is FIFO and this is LIFO. And there's my temporary difference, which was the movement. And then I'll times it by the 28% to get the tax, which was this number. Do you recall? So when I do a deferred tax calc, it appears. Let me see if they have a tax calc. For 2011, it still appears. For 2012, it disappears. Now it's FIFO, FIFO, and then it disappears. Yeah. Deferred tax movement. Oh, no. No tax calc. Did you see a tax calc anywhere? It says your current tax. Is there a page that I didn't paste on that has a tax calc? Have a look at page 73 or something like that. There isn't anything on page 73, huh? A tax calc. A tax calc. For the same example. Yeah, okay. Why did I not? No, I didn't. Let me open it quickly. Okay, let's look at the adjustment they're making on the tax calc. And the adjustment they're making here is, and now? And it's not picking up that I picked up a pen, and there's a pen missing. Yeah. If you look at the adjustment they're making here, it's that less that, isn't it? If you look at the number, it's 616. 616 is the adjustment they're making to the tax calc. Now, the adjustment we expect to see on the tax calc is the difference for the prior year. Yeah? If we look at the prior year, for accounting, we would have had opening inventory using FIFO. For tax, they have opening inventory using LIFO. Yeah? Opening inventory is 2011. 2011's inventory. When we go back and we look at our calcs for 2011, more. If I go back and look at my calcs for 2011, this was my number. Or my impact on cost of sales, rather, not 2011. The impact on cost of sales in the current year. There's the 616. Do you see it? And that's what they're adjusting the tax calc by. So I was hoping that we would see more of something that looked like this, which was my picture that I drew for you. I said, in the current year's tax calc, we're going to pick up this movement between the LIFO and the FIFO, isn't it? I was hoping you would see that. But we don't see it that clearly in the tax calc that they've prepared. But just remember that when we have this, it affects the deferred tax calc and it affects the current year's tax calc. We might see that in the assignment question that you need to do. Okay, so before I wrap up accounting policies, the majority of the time, I don't think I've ever seen a change in accounting policy at third year level that isn't inventory. Okay. In practice, changes in accounting policy occur mostly when there are changes in standards. And at an honors level or at board level, when they ask a change in accounting policy, it's usually because of a change in a standard. Yeah. So, for example, the revenue standard was issued recently, and that standard may result in a change in how some companies accounted for revenue, isn't it? And if it did, they would have had to go back and change and do a retrospective change. For your purposes, changes in accounting policy are almost always to do with inventory. And here's one. In the second assignment, and luckily this assignment is multiple choice, there's a whole lot of stories. Additional information 1 has to do with a change in the depreciation rate, which is a change in estimate, which we won't deal with today. But additional information 2 is a change in accounting policy. So they say during the financial year they decided to change accounting policy to comply with IFRS. They previously used weighted average and they're now using FIFO. Although IFRS does allow weighted average, so I don't know. But they said that they want to comply with IFRS, so that's what you'll say. So there's the 3 years. They haven't given us more than the 3 years. They've given us FIFO, weighted, and they've given you the difference already, and they've given you the tax. Remember, this difference is the difference in the inventory balance. It's not the cost of sales piece. The cost of sales piece you still have to do. Let's see what else they say. SARS will not reopen the previous year's assessments, and the new method will not be accepted by SARS. That means that they will continue to use weighted average. We will continue to use FIFO. So it'll be a bit like depreciation and wear and tear, isn't it? Whereby they will do one thing and we will do the other until it gets used up. An asset takes a long time to get used up. Inventory gets used up in a year. So every year it will just roll. So they will not reopen and it will not be accepted. So it's all deferred tax. Okay, number 3 is an error. All right, let's see which ones we can answer. The carrying amount of machine delta after the change in depreciation, no. The tax base of machine delta, no. That's a change in estimate. We'll do it next week. Due to the change in estimate, the following will be disclosed. That's next week. The change in inventory valuation method. Okay, so this one we'll be able to do. Question 4. The change in inventory valuation method. Question 5 we'll be able to do. The carrying amount and tax base of inventory in deferred tax. This one we'll be able to do. Question 6. The carrying amount and tax base of inventory in the deferred tax. That one we'll be able to do. Question 7. As a result of the change in inventory valuation method, what will be disclosed in the statement of financial position? That one we'll be able to do. Assuming that the comparative
can be reopened for purposes of recording this journal. The following journal should be recorded to correct the bonuses. This is an error. There's obviously an error. 9 is to do with the error. 10, which one of the following measurement bases? Okay, 10 is framework, which we haven't done yet. We'll do after we've done changes in policy. Is that it? Yeah. Okay, so I want you to do questions 4 through to 8. 4, 5, 6, 7, 8. 5 of them for this change in accounting policy, which is this piece over here. And then the piece on the next page, which deals with the change in estimate. With the change in estimate, with the tax. The tax bit's not here, no. Okay? So I'll give you a bit of time to try and do that, and then we'll debrief. 2. Okay, let's have a look. So they gave you the movements in inventory. All you needed to do was work out if they increases or decreases. Do you agree? So when we look at them, sometimes they put old first and then new. Sometimes, in this case, they put new first. Just be careful, right? So FIFO is new. Weighted average is old. I checked 3 times to make sure that's true. I'm going to check it again. Previously, we're using weighted average. Now, FIFO. Okay. So it is increases in each of the years, isn't it? From old to new. So I've put little arrows increasing. They gave you the tax effect. The tax effect is all deferred tax. Do you also agree with that? Because they said to you that SARS is not changing it. And because we're dealing with a liability, if an asset goes up for our balance sheet to balance, the liability must go up as well, isn't it? It's a debit and a credit. So it's a debit there, a credit here. So this deferred tax liability is also going up. Then when you're looking at cost of sales, it's the movement. So when I looked at it, and I actually left my mistake on to see if you guys double checked it, but then I saw that the solution didn't give you the 2 options of increase or decrease. So once you had your number, you pretty much knew which one it was, isn't it? But look, the direction is going this way, whereas in the previous example my direction was going the other way, isn't it? So this is the direction. An increase of 35, and the next year only an increase of 32, which means more costs are landing up in P&L, isn't it? Less costs on the financial position, more in P&L, because my balance is dropping. What happens when my inventory balance drops? More costs are going into cost of sales. That's how come it's dropping. So therefore, actually, cost of sales is going up. More costs are, if inventory is dropping, which is what's happening here, from the 35 to the 32, inventory is dropping, cost of sales is going up. And then from inventory is coming down, so cost of sales is going up. Inventory is coming down, it's a credit, so it's a debit to cost of sales, an increase. And then the same here, inventory is dropping from 32 to 15. When inventory drops, it is a debit to cost of sales and a credit to inventory. So that's also an increase. The tax amounts were 4760 and 840. Although, just for completeness. And the tax amounts go to tax expense because current tax and deferred tax land up in tax expense. And when cost of sales goes up, profit is coming down, so tax comes down. Be careful with your directions. Right, let's look at the questions. So the first one we had was 4. 4 says, the change in inventory method will have the following effect on cost of sales in the statement of P&L for the year ended December 15. So what's going to happen with cost of sales in the current year? It's an increase of 17, which is what everybody said. It's a pity they don't have, like they should just pick 2 or 3 and have the increase and the decrease number on there, because then it forces you to really think about which one it is. In this case, the minute you'd worked out the 17, it had to be that answer, isn't it? And I know I put the arrows wrong on the board, and then Pearl was saying, which way does it go? So, okay. Question 5.
The change in inventory valuation method will have an effect on cost of sales in December 14, the year before, of 3. An increase of 3. That was right, eh? 3. 2, which is, everybody said 2. The carrying amount and tax base of inventory in the deferred tax balance as at December 14, so we're looking at the previous year, and remember, carrying amount, we're going to restate. Carrying amount will be FIFO, and tax base will be weighted average. So the answer there was 172, 140, number 1. Is that what the rest, what all you guys all told me earlier? Number 1. Let me check. Yeah, you all said 1. And then you said 3, and then you said 3 or 4. You weren't sure. Let's have a look. 7. The carrying amount and tax base in the calc as at December 15. Now, this is where if SARS had accepted and wasn't going to reopen the past but would have reopened the present, the balances here would be the same, isn't it? But actually none of them are the same. So they didn't even give you the option where they're both the same. I don't know. We're looking at balances of inventory in 2015. So that's a very obvious and easy answer. The balances of inventory in 2015 are number 3, 110 and 95. Yes. Okay, then number 8. As a result of the change in inventory valuation method, the comparative amount of inventory at December 13. December 13 is what I call that prior year, isn't it? The third year back. And we're looking at inventory in the statement of financial position, SFP. You'll see that they give an option, which is that we won't disclose 2013 as a comparative. And I'm not sure if that's the answer, to be honest with you. Or whether the answer is 120. Because when you go back to 2013, but the reason I'm not sure if my answer is a technicality, and I'll leave it up to you to decide. If we go back to 2013, remember we're going to restate inventory, isn't it? So we will be showing inventory at that number. Okay, now, the only distinction here is really a technicality. It's one of those like really ugly little things that sometimes... Can you see, this is the financial position, that statement that I showed you earlier. Oh, they didn't show it. We didn't see a statement of financial position earlier. Okay. Okay, let me show it to you here. Often this is the way it would show. It would show 2012, 2011, and then instead of saying 2010, it'll be the opening balance. So it wouldn't say 31 December 2013, it would say 1 January 2014. Now, I'm not sure if that is what it says or not. Let's have a look in the study guide and see if they show it. I think they might show it under IAS 1. Can you see? Look at page 64. I closed it. Okay, can you see here it says, the revised IAS 140A has introduced a requirement to include a third statement of financial position as at the beginning of the preceding period, which means that your balance would be as at 1 January 2014, not 31 December 2013. So, I'm going to leave it up to you to decide which one you're going to do. If you're going to say that it is 3 or 4, which is exactly actually what
the lovely answers that Christian gave me earlier. He said it's either, no, you said 3 or 4, but it's not 3 or 4. It's either 4 or 5. So there is a requirement to show a third year. But the third year is not at 31 December 13. The date that will appear should be the beginning of the preceding year. It should be 1 January 14. And I know it's a technicality. It's the same number. It's the same date. Say, the last year, the first day.
But it's the comparative amount of inventory on that date. So it doesn't say you must put it in as that date. It says that amount.
But as at that date, we won't have a column with that date. That's the technicality. Our columns will be, as they appear in that note, our columns will be the year ended 31 December 2015, 31 December 2014, and 1 January 2014. That will be the technicality. So I don't know. If you put 5, I think that's the most technically correct. But it is, we're nitpicking, isn't it? I don't know if they will mark it wrong. Because we will show that inventory as a comparative. It's just that we won't show it with that date. So you're saying that they're not talking about the date. They're just talking about the amount. So Ashley's going to say that one. Okay. We will show that number. Yes, it's true. We will show this number. We will show that number with this date. I'm sorry. Maybe they will give you some further guidance. When the time comes, just flip a coin. Flip a coin and hope for the best. Or what we can do is, this half of the class can do 4, and this half of the class can do 5. And then we'll see who gets, it's out of what? 12. So 1 counts quite a bit, hey? I don't know. It's like,
2 marks.
Huh?
Every one of them is
2 marks. But what's it out of? Are there 10 questions? No, are there only 10?
Yeah.
Oh, okay. Yeah, so yes, it counts 10%, 1 question. So 10% is a lot. Don't you think it's a lot? It is a lot. It's like 1 question, but 10%. Like we get 2 wrong, you're already on 80%, and you only got 2 wrong. All right. So that is changes in accounting policy. I want to give you a chance to just practice one more. In your study guide, because I want you to just practice doing the note for me. So in your study guide, we're going to look at, I don't know, we may as well look at example 4. Or example 3, which one? Or example 2, let me see which one I think. No, example 4 is the one that's a combined example. Okay, example 4, page 85. And what I want you to do is I want you to start off by setting up a note for changes in accounting policy. So go back to page 60, page 70. So from page 70, set up a note. Don't put the increase or decrease in yet, because you don't know if it's increase or decrease. I suppose you can set it up as it is like this, and then if you find it's going the other way, you can cross out, isn't it? But set up the note from page 70, because that's what you will always do. You will always set up the note first. Then you're going to go and have a look at the information about the change in accounting policy on page 85, and then I want you to complete the note. So your note is going to say blah, 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 blah. And then it's going to have effect. And they put cost of sales first, and tax expense, and profit. And then they have inventory. And I'm going to put current tax and deferred tax in, because I don't know which one it is.
current tax, deferred tax, retained earnings, or equity. Sorry, they don't say retained earnings, they say equity. And then retained earnings, beginning of year, prior year. Okay, just a very summarized one. And then you're going to have the years. If I just look at page 80 just to get my years. No, page 85. The year end is 2012, so I'm going to have a 2012, a 2011, and a 21 Jan 2011. We may as well get used to doing it right. Okay, which is 2010 in effect. Okay, so what you're missing here are numbers. No, there's no number here, right? Because this is P&L, no number there. But here there are numbers, and there's a number here. So what you're missing is numbers and directions. You can try and do it straight from here to see if in an exam you would be able to do that. I'm not sure how many marks it is, so I don't know if like there would be workings marks if you got the numbers wrong, but they could go and look at your calc, isn't it? So it's maybe a good idea to do a calc. I know that my honest students, they try to plug straight in. Wherever you can save a bit of time, you save a bit of time, isn't it, for somewhere else? All right, let's have a look. So you can have a little break if you want to go for a cigarette, Ashley. Otherwise, you can just plug in. Let's see if you can do the note. And if you can, then you can go. 512 is tax. Okay, so if you have a look, then cost of sales is going up. Did you get that? No, it's going down. Going down, decreasing cost of sales. When you look at the movement, inventory is going up. When inventory goes up, the money must be coming out of cost of sales, so cost of sales is coming down. So it's a decreasing cost of sales for the 2 years of the 21 and the 3400. Do you agree? And then because cost of sales is coming down, it means profits going up, so tax is going up. Increasing tax, 588 and 8512, which is my numbers that I had there. I'm going to just put XX, it's the net number then, is the profit number. Yeah, you can put a bracket there. And it is an increasing profit. Then inventory is also each time increasing. And the numbers for the increase in inventory are 37,500, 35,400, and 5. And the tax, the related tax, 1,400. So the tax, they said, it's not accepting, so it's all deferred. Yeah? Do you agree? Oh, they're not accepting the prior years. Sorry, I didn't even read that. As I was saying that, I was thinking, I'm sure that that's not even this question. I didn't read this question. So let me just undo. All right, so the tax for the prior years, let me just fix it so that it looks more like there's a space there. Let me actually put a space there then. Okay, so let's just have a look at one by one. When my inventory goes up, then my current tax or deferred tax liabilities also go up. Do you agree? So those both are up because they are liabilities. Current tax liability, deferred tax liability. Current tax would only apply in the current year, so it doesn't apply in the other 2 years. It applies in the current year. The current year is 10.5. And then deferred tax doesn't apply in the current year. It applies in the prior years, 9912 and 1400. Do you agree? All right, so then that gives you a number, whatever that number is. Because my assets are going up, it means my equity is going up. Retained earnings beginning of year, which is the prior year adjustment, is that same number. Yeah, and you also have to say, for that one, you just say adjustment. You don't say if it's up or down. Okay. So that's the note. That's the majority of what gets asked. Let me show you, let me just pull out a prior year exam quickly that I have at the back here, just to give you an idea of what that's worth, what that note is worth. So it almost gets asked in every single exam.
F. So last year it was asked in October 14, which happens to be the one that I've picked up. It was asked in question 1, part F, and it was 15.5 marks for this note. Disclose the note for the change in the accounting policy in terms of IAS 8. 15.5 marks. So it's worth a lot of marks, isn't it? So it's about making sure you know what the note looks like, then doing your calcs carefully, not making mistakes like me, and then making sure your directions are all right, and then checking your tax and your deferred tax. Okay, it's worth a lot of marks. Between tax and this section, it's easily 2/3 of your paper, of your final paper, because it gets asked so much. All right, so next week we'll carry on. We're going to do changes in estimates and errors next week.